All right, and welcome to Freeman's Focus. While it's difficult to accurately make a prediction about the housing market, I'm going to use some key data from Black Knight, Altos Research, Core Logic, let you know what I think I can see logically happening in the industry in 2023. Ultimately, the housing market and interest rates are influenced by a variety of factors, such as economic conditions, government policies, market trends, to say the least. So here's five uh, potential expectations for the housing markets and interest rates in 2023. So increased housing demand. Number one, the housing market may see increased demand in 2023 as people look to buy more homes due to low interest rates, a strengthening economy, and desire for more space due to the pandemic. Now, more space can go a number of different ways. So Forbes writes right here that 32% of young adults, millennials, moved back in with their parents during the pandemic, and two-thirds of those people still live there. So this might be the year that they start moving back out on their own. Lots of things could happen though. Parents finally selling a house, so that never happens again. Once you're gone, you're gone. And parents, maybe buy a bigger home. So if it does happen, then their children and their families will definitely have a place to stay. Um, Alternatively, the young adults who move back home could purchase a big home themselves and bring the parents in. Right now, I've seen, heard reports of new construction builds, including in-law suites with the build. Number two, the rising home prices. Um, if demand for housing increases while the supply remains limited, it can lead to rising home prices. And this is something that everyone believes will certainly happen. Right now, inventory is high in most markets. I've seen a lot of success. Uh, the most is Texas, Florida, California, Arizona. While other markets, in Illinois, uh, have have seen drop offs where you know their inventory has dropped drastically in quarter four and year over year. So, um, however, year over year, we did see many more homes selling in quarter four than last year, or sell more quickly in quarter four than last year. So prices will certainly begin to rise in all markets as home buyers take to the streets. And you know, however, the normal expected 3.8% equity gain should continue to be seen year over year, no matter what market you're in. Number three, the low interest rates. Interest rates, they remain low in 2023. We're going to say they're not going to get up to the 13s and in the 12s. I don't even see them reaching anywhere near 10. So, the Federal Reserve is going to continue to support the economy and keep borrowing costs low. So we've accepted that we're firmly in the middle of a market correction. So I don't personally think that this has gone bad. I think interest rates were kept low for most of the year, with the exception of the last 2 weeks in quarter two or quarter three and quarter four, reaching to well above 7%. And while 7% isn't 3.5%, we can surely um, we can surely see that 3.5% is unreasonably low and unseasonably low, and likely never happen again unless you get into a 10-year, 15-year adjustable rate mortgage in an incentivized market. So 7% is just above what the normal was, and 7% was normal in 2002, as we see here. Um, Ending quarter four, we saw a pretty big dip in the rates also, um, due during the absolute slowest time of the year, this December and quarter four. Rates just shot down, pricing shot down, and it was very, very affordable in that regard. And for all that we've gained, we've lost a lot as well. So my prediction is the market doesn't correct. Um, my prediction: the market doesn't wait for spring to get going again. It'll be more like mid-February before we see buyers in mass out and about looking for homes. Tight inventory is number four. The housing market may continue to have tight inventory in 2023. Um, the new home constructions hasn't kept pace with demand, and this could lead to more competition for available homes and potentially drive up prices. So you've got to understand that this statement is for the housing market overall. When somebody says the housing market, and you're not seeing the same thing when you walk out your front door doesn't mean it's not true. So across this U.S., things are drastically different. For example, in Florida, new home construction exploded. Right, there's a ton of land that sold and tons of new home built on it. 7 per acre, I think, is the number. So some issues that potential home buyers might see as migrants flooding into Florida and purchasing, the remaining inventory. That would lead to the construction supply not being able to keep up with the demand. So that could happen as early as February, like I mentioned, at which point the prices start to increase again. And with the saturated buyer, making the saturated market from buyers paying too much over asking. So number 5 is going to be the continued growth in certain markets. And the biggest thing that encapsulates this entire report is going to be affordability, right? And I have to address affordability. This is going to be the main player in every transaction in 2023, it looks like, at least in the beginning of 2023. So, and foreclosures aren't making an impact yet. The rate of foreclosure is still down 44%, as we can see here. And we're talking about a huge number, right? And it's down from 44% from the years preceding the pandemic. So before that, we're still way down. And I want to make mention of it only to make mention of it. and I've had some combos where that was brought up, but I don't think it's a talking point yet. Affordability doesn't really relate to the unemployment rates as well, because those from people who don't have jobs, they're not potential home buyers. So we've got to take that number also with a grain of salt. And what we can factor in, however, is that the cost of goods has risen, and that's had a huge impact as well. Very simply, lots of potential home buyers with the otherwise decent wages are being priced out of the market they're in. And this kind of proves that there won't be a crash. If lenders were to keep qualifying people and getting them into these homes that they couldn't afford, then they'd belly up, then we'd have a crash. And I don't see that happening. The underwriting guidelines have been pretty strict on what proof is required to purchase a home, and a lesson learned from 2008. With regards to home prices falling slightly, anything you buy depreciates in value the second you get it. A car, any items, a stereo system, or whatever. Real estate has always just been one of those investments that tends to always appreciate. It's a safe and sound investment. It's always good to invest in real estate. So, in conclusion, if it looks like by design the market will be corrected by affordability, the guidelines, will loosen here and there over the years, and there's going to be programs that help encompass more demographics and down payment options as well. But ultimately, making more money is the answer to all the questions, right? It's always the answer to more. But the silver lining is that in job markets like California and Arizona, where they increased their minimum wages to over $14 an hour, there's still states that are still set at the federal minimum of $7.25, and they'll soon follow. So if we look here, this was just a market segment in my zip code, and we can see here January 2020 when the pandemic really started to take effect here. We can see and went through March, April, May. Things are happening. Some of the main players are getting in. Some of the people who pay attention to the market, and then just everyone started flooding. Right by January 2021, we took a little dip here between September and January, and then a huge dip between about March and that previous September. And what we're seeing here is what I believe this to be is a lot of fix and flips. So we went and we started these players here who started buying these houses. The people who were selling invested it, reinvested it, and now they're doing fix and flips. And we saw a lot of this in the refinance market coming from California and Arizona, where these inflated prices were just out of control. And they've taken, $200,000 out of an $800,000 house and used all the equity, that $600,000. Had a couple people go in to an investment with them and went to these markets, Florida, Kentucky, Mississippi, Louisiana, these markets like this, and just started buying up a lot of properties and flipping them. So that's what we can see here. And then this is a nice, healthy gain. I'm going to move myself out of the way here a little bit so we can see the dates. But this is a nice, healthy gain. So I don't think we're going to see a crash. We've got this super inflated influx and then just steady gains all along the way for the next entire year. And we're seeing a little dip here, as we've seen a little dip here, and then the rise, flatten out and a rise, flatten out. And you can see these are over 90-day trends. Sure, the 7-day trends, we've seen these super high fluxes, right? And then little drop offs. But like I said, these are really nice, healthy gains. So I hope this has been helpful. I want you to stay tuned for the next episode or the next segment of Freeman's Focus, um, where we'll talk a little bit more about current market conditions as well. And thanks for joining.